What does the bond market tell us about growth? Well, obviously, the record level of negative yield in bonds is a very clear signal of disinflation and stagnation. The macroeconomic data continues to be weak, and more importantly, inflation expectations come down. Lower interest rates are not driving higher capex. Why? It's very simple, because weighted average cost of capital is not coming down alongside cost of debt. The equity risk premium is actually rising. More importantly, another of the reasons is that there is not a question of low rates and high liquidity. Companies have plenty of liquidity and ample supply of credit out there. However, what they're not seeing is an improvement in economic data and in the level of demand that they see for their products and services. Therefore, there is no need to increase capex when overcapacity is perpetuated by low rates and high liquidity. As such, what we need to understand is that what the bond market is telling us, with junk bonds in negative territory in Europe, with emerging market bonds, some of them showing negative real returns, and as well a record level of negative yield in bonds, is that what we're facing is a period of stagnation and low growth. Equity markets probably too aggressively optimistic about the cycle. And what we need to simply do is to acknowledge what the bond market is telling us. And what it's telling us is that low growth and disinflation are here to stay.